Okay, everybody, this is going to be a really good lesson on probabilities and how we come up with the strikes that we use in probabilities. Okay, so first thing I want to start with is when we figure out an expected move, when we calculate an expected move, whether it's from us figuring it out or just looking on Thinkorswim and, it gives it to us, what sort of probability based on the option pricing model or the Black-Scholes trading model, what is priced in terms of a probability of that move? Perfect. Ken, Tom, Rod, you got it. One standard deviation, Brock, yep. And a one standard deviation move, which is about 67%. Okay, so when we are calculating the strikes that we use, when we are calculating, which position to take on, we are basing it off of the expected move to a certain period of time, which is calculated with a one standard deviation probability, or 67% of the time. Okay, everybody clear with that? And I'm gonna whiteboard this as well. What is today's date? Today's the 18th. Wow, Christmas is 1 week away. Okay, so expected move. We're gonna title this expected move standard deviation discussion. Okay, so when we calculate the expected move in a stock, or TOS does it for us, okay, the expected move is a one standard deviation probability, or approximately 67%. Okay, does everybody understand that? Even you newbies out there, do you understand that? So when we are calculating an expected move, it's a 67% probability, mathematically, the expected move. So for instance, let's look at ACN right now, okay? Since we're trading ACN. Stock is 205 and change. The expected move is about $8. Okay, if I look at the straddle right now, the expected move is about $8. When we were looking at this earlier, the stock was trading like 204 and about 204 actually when we put our signal out there. Okay, so ACN was 204 and the expected move was plus or minus $8.50. What that is saying is that the market is projecting, anticipating that ACN will trade in a range of $8.50 from that current stock price. So from 204 plus or minus the $8.50. So an expected range, which we go through this every time, of 186 195.50 up to 212.50. Okay, that is with a 67% probability. Okay, everybody get that? Everybody understand that? Okay, now the article that Dean, that you posted up here, and I don't know if anybody looked at it, okay. Dean posted an article on CNBC that says a trader has a strategy that wins 90% of the time. That's easy. That is really easy to come up with a strategy that wins 90% of the time. Yep, I'm going to go through that, Ken. I'm going to do it on AZO. Why doesn't it make sense, Pamela? The magnitude of the move is not predicting a direction. It's just predicting the amount. It is not predicting the direction. So there's really a 50-50 chance that it's going to go in either direction, that 67% probability to that expected range. Okay. What makes it 67%? The mathematical option pricing model, the Black-Scholes pricing model. Remember, we talk about this all the time. The calculations, the formula, you don't need to know the inputs, you need to know the output. So the mathematics behind the option pricing model, which is based on volatility, time to expiration, and some other factors, calculates a 1 standard deviation probability. Okay. And a 1 standard deviation probability in mathematics happens 67% of the time. So again, if you think of back when you were in school and you had a test that was curved, okay, well, what did a teacher do? Okay, well, you would have a graph like this. Okay, this is a curved exam with this area right here okay, being that it's a bell curve, exactly, being that 1 standard deviation area right in here, 1 standard deviation area, okay, that's 67% of all the data points. If you go out to 2 standard deviations, okay, that now includes roughly out to about here and about out to here. That is just over 90% of all probability. Okay, so let me see if I can actually fit that in here. And Steve, you're the statistics professor, so you can give me the exact breakdown on that. Okay. So that widens out. So then anything within that range from here, right here to right here is going to encompass 90+% of all the probabilities. Okay? So what this trade example, not ours, but the one in the CNBC video, which is talking exactly about AutoZone, is saying is that it's going to win 90% of the time. Because the trade is set up to win between this point and this point. Where our trades are typically set up to win between this point and this point. Now, why would you want to go for one or the other? What is the benefit of one or the other? Bingo, reward to risk. Reward to risk. It's all about reward to risk. So when we calculate our expected move and base our trades off of the one standard deviation move, we have a certain data point of reward to risk that we want to see. Obviously, if we were going to make trades off of a 2 standard deviation move, or 90% probability, so the probability of the trade working is much higher, but the reward to risk is much, much less. So yeah, you're going to win 9 times out of 10. The math says you're going to win 9 times out of 10. But the one loss you're going to take, the 1 out of 10, is going to negate the profitability in the 90% that you're winning. Pretty close, Bevan. Yes, pretty close. You're right. So let's go back, and I'm going to reconstruct exactly what the scenario was. Okay, so let me play this video here and get the exact numbers again. Hang on.
85 call strike. And if you 1082.5, the options market is implying a move of a little over 5% .
Okay, so this was in AutoZone. The example was in AutoZone, which I'm going to put up on the screen here. Thank you, Ken. Okay, but we're going back in time. We're going back to right here, the day right before earnings. Okay, on the 9th of December. So on the 9th of December, the stock closed, you can see, at 11.69. Okay, so on December 9th, closed at 11.69. The expected move was 5%. So the expected move was about how much? The expected move was about $58.50. Well, what I'm doing, Dean, is I'm going off of here. I'll post this right here. I can go back. I can find that data, but I'm going back right off what the video says here. Let me play it. You can see it right on the screen here. He's telling us the implied move was plus or minus 5%.
At the end of the week. But the trade that I saw, daily options volume in AutoZone this morning going into earnings, this is a name that typically moves a little less than 6%. The options market is implying a move of a little over 5% by the end of the week. But the trade that I saw...
Okay, so he just said it also. The option market is implying a move of about 5%. Okay, everybody with me on that? And I'm hoping the video is coming through when I'm playing it, that the audio is coming through okay. All right, so let me take this off the screen for a sec. We'll go back to our whiteboard. So if the expected move was 5%, which is 58.50, that gives us an expected range, okay, of roughly 11.11 up to 12.27. Okay, everybody agree with that? That would be the expected move, the expected range with a 1 standard deviation probability. Okay, so this is 1 standard dev probability, or 67%. Okay, now let's continue with the video here. Hang on, let me bring this back in here.
Go on the markets today that I thought was pretty interesting was something called an iron condor. Somebody sold the 1087.5, 1082.5 put spread, and also sold the 1285, 1290 call spread. Both of those are going to be expiring at the end of the week.
Okay, So here's the strike. So ordinarily, if we were looking for our one-to-one reward to risk based on the one standard deviation move, okay, we would have sold something as an example. Okay, we would have sold maybe the 11.15, 11.10, and 12.25, 12.30 iron condor. And we would have wanted to get somewhere around $2.50 for that, right? That would take us right to that expected range. Close on the downside. I know the break even there on this would be 11.12.5, just above what the expected move was. And the break even on the upside would be 12.27.5. But that's, you know, for example purposes, those are the strikes we would have used and the reward to risk that we would have wanted for that one-to-one reward to risk. Make sense? Everybody on board with what we would have done? Okay. The trader actually did, and let me play this back for you, and then I'll put it back up here. Hang on. And Dean, I think you're the one that posted this, so thank you so much for posting this, because I think this is great insight, great learning for everybody.
Sold the 1285, 1290 calls. Iron condor. Somebody sold the 1087.5, 1082.5 put spread, and also sold the 1285, 1290 call spread. Both of those are going to be expiring at the end of the week. That $5 spread on both sides, they collected just 65 cents per share. But here's the thing. This is a trade that is betting that the stock is going to stay above the 1087.5 put strike and below the 1285 call strike. And if you look back the last 11 years, 44 reported quarters, only twice out of those 44 quarters have we seen moves of greater than that magnitude, meaning that this trade has actually been profitable 95% of the time that somebody has put it on. So sometimes...
Okay, so here's what the trader did, which took the break even down. And remember, he only did this for 65 cents. Right? So we look here for our reward to risk of about 1-to-1. Okay? Here, this trader's reward to risk was 0.15-to-1. So all he could make was 65 cents. He could lose $4.35. So the break evens here would be 1086.85 up to 1285. $65. Okay, so yes, you can compare here and see the probability area, the break-even area, is far greater than what we had, right? So the probability of the trade working is much greater. However, do you want to take, does anyone here want to take that amount of risk? I don't. I don't. Ken, absolutely. Absolutely. There's no question about it. But when it does make that move, okay, that 10% of the time that it does make that move, it's going to wipe out the profits from the times that you make your 60 cents. That's the key. So lots of times, and you'll hear, and I've told you guys this often. I'm sure you all get inundated and peppered with email after email about systems, trading systems that win 90% of the time, right? 90% of the trades are profitable. And I don't disagree. I don't disagree. These people are being truthful when they tell you that 90% of their trades are profitable. What they're not telling you is, though, the probability and the reward to risk, and that when they have that 10% that is not profitable, it's wiping out the profits from all of the wins. There are lots of people that will sell 10-cent options that are so far out of the money. 15-cent option, 20-cent option, whatever it is, that are so far out of the money. And you collect and you collect and you collect and you collect and you make money repeatedly until that 10% of the time or 5% of the time, whatever it is, happens. And it will happen, right? The odds happen. The math works over time. Probabilities are there for a reason. You may win 18 times in a row, but if the math tells you that it's a 90% probability, that means the next 2 times the probabilities are that you're going to lose. Over time, the math works. Okay. We're also not taking into consideration here, Steve, the expense of commissions and the margin expense. Because when you sell a spread like that, or you sell out of the money options like that, the amount of margin that you get charged is very, very considerable. Okay, so again, the strategy of selling those out of the money options, I am absolutely not disagreeing with the fact they can win 85-90% of the time. Just, it's kind of that caveat emptor, buyer beware. Well, margin is the amount of risk that you have to your position, Pamela. So if I'm selling something, like in this instance where I am collecting 65 cents, but I can lose $4.35, what the clearing firm or your brokerage firm is going to do is charge you for having that risk. Oh, that's a good one, Robert. That's a good one. And I think I only brought up the caveat emptor because any of you that are Brady Bunch fans would know where I'm coming from with that. And I'm a huge Brady Bunch fan. Pamela, you have to ask your clearing firm. They're all a little bit different, but it's unbelievably restrictive. And I think in that episode, if I'm not mistaken, Greg was trying to buy a car. And he was getting a really, really good deal, but realizes that it's a garbage car. All right, so anyway, if you want to do something like that, just realize the risk associated with it. And again, Dean, thank you for bringing this up. Everything that, the guy on CNBC said was accurate. The one thing he did not cover was the amount of risk to the trade, which I think, for me, being in this business, I think that is a major, major piece that he left out of the puzzle there. And David, bulls and bears prosper, pigs go to the slaughter, right? All right, guys. This was recorded, so let me get this. Yeah, right, Robert? It's the Zach stuff. You're right. It's the whole Zach's thing. Let me get this posted up in the room, both the whiteboards and the recording, and I will be back. Thank you guys for listening. I know I went, kind of off the beaten path a little bit here, and I probably wouldn't have done this unless it was for Dean. So you can thank Dean for bringing this up.